Today, we're going to take $1,000 and build a dividend portfolio. The reason that I like dividends is because they're a true form of passive income. All you have to do is buy the stock, and then at regular intervals throughout the year, you get the dividend. People often wonder how they can start their own dividend portfolio. So today, I'm going to walk you through it step by step. By watching this video, you're going to learn 1. The pros and cons of starting a dividend-based investment portfolio. 2. What to look for when selecting stocks in a dividend portfolio. And finally, I'm going to show you an example of a dividend portfolio that I made with $1,000. I'll also share with you some of the analysis that I used to choose some of the stocks for the $1,000 portfolio. So, let's get into it. First, we're going to be talking about the pros and cons of a dividend portfolio. Starting out with the pros. Number 1 is passive income. When you own a dividend portfolio, it's a true form of passive income. You just buy the underlying security, and every now and then, you'll get paid a dividend. Now, if you don't know what a dividend is, it's basically when you buy a stock, that company has so much in profit that they will pass some of that profit back to their shareholders. Typically, dividend stocks are larger blue chip companies. Now, it is possible to build up such a large dividend portfolio that all of a sudden you can live off your dividends, but you do need a lot of money invested to do that. The second pro of owning a dividend investing portfolio is compounding returns. When you reinvest your dividends, the growth starts to build upon itself and really just catapults your portfolio into that next stratosphere. And lastly, dividend portfolios protect heavily against inflation. Dividends have increased at a rate of 4.2% since 1912, and inflation during that same time period has been around 3%. There are some cons in investing in a dividend portfolio. Let's go over them really quickly. The first con is that you only own large cap corporations and companies. The reason is because a company that can pay you a dividend is already established, and the majority of dividend paying stocks are blue chip stocks. So in terms of diversifying your assets across all different types of companies, such as smaller companies that have a huge growth potential, you don't really get that with dividend paying stocks. Second is your returns might be limited when a company pays a dividend. After the company goes ex-dividend, the share price typically drops by the amount of the dividend paid, to reflect the fact that new shareholders are not entitled to that payment. And lastly, companies can cut their dividend at any time. They're not actually guaranteed. The company doesn't owe you a dividend just for owning their stock. Now, obviously, some of the dividend aristocrats, as they've been called, have been paying a consistent dividend over the past 25 years, and also growing their dividend over the past 25 years. So they're not likely to cut their dividend. But for example, a big company like Intel just cut their dividend by 65% this year, and that's one of the cons. You just don't know if dividend stocks are going to pay or not. So those are the pros and cons of owning a dividend investment portfolio. I would say if you're a long-term investor who's looking for some cash flow, then a dividend portfolio is actually a pretty good idea for you. But if you're someone who prefers a lot of growth and wants to diversify across a large number of companies, not just large cap, but also small and mid caps and other types of investments, then a dividend portfolio might be a little bit too safe or a little bit too boring for you. But let's say we want to invest in a dividend paying portfolio. What are the key components we should be looking for when actually starting our own dividend portfolio? The first thing I like to look for is a company that has a good track record of paying their dividends. The last thing you would want when investing into a dividend paying stock is that it cuts its dividend. To find out how much a company actually pays in a dividend, you can look up their ticker symbol on Yahoo Finance or Google Finance, or if you just want their dividend history, there is dividend.com. The second component for a dividend investment portfolio is to look at the yields but don't chase the yields. Different companies will pay different amounts for their dividend, and that dividend as a percentage of its share price is known as dividend yield. For example, a company like AT&T pays a dividend of $1.11 a year, which as a percentage of their share price is 6.09%. Compare that to Home Depot, which pays about 8 times that at $8.36 a year, but as a percentage of their share price, it's only 2.8%. So if you invest $1,000 in AT&T, you would get 6.09% of that back every year. And if you invest $1,000 into Home Depot, you only get 2.8% of that back per year. The biggest note here though is that high yields are not always a good thing. Many dividend investors get caught up into really high yields, like they'll just go for the company that pays the highest percentage for their money back, but those stocks don't always return very well on a total performance basis. If a company is paying a huge yield on their dividends, it's likely that company is not reinvesting their profits and trying to expand and grow their underlying business. So that brings me to my next point, which is you got to pay attention to the dividend payout ratio. The dividend payout ratio is simply represented as total dividends paid divided by the company's net income. The easiest way to put this is, say a company gets 10 million a year in profit and they're paying out 5 million in dividends. That's 5 million divided by 10 million. So their payout ratio would be 50%, which means they're paying out half of their profit every year. The more a company is paying to their shareholders, the less that they're reinvesting into their business, because all their money is going to their shareholders and not their business. Companies with a high dividend payout ratio have less money to work with, and thus their growth potential is stunted. When selecting a stock, it's important to pay attention to their payout ratio, because you want to assess whether or not you think their dividend is sustainable in the long term. Lastly, the fourth thing we should be seeking in a dividend portfolio is diversification. Ideally, we want to choose between 15, 20, 25 or 30 stocks that are all dividend paying across multiple different industries. What we are doing with the dividend investment portfolio is we're investing for future income cash flow needs. We're not trying to shoot for the moon in terms of total growth. Yes, it is a little bit boring, but you're definitely going to sleep better at night knowing your investment portfolio is not going to be super volatile, especially if it diversifies across all different types of industries and across different companies. So now, let's have a look at a sample portfolio that I built with $1,000. I chose 16 stocks here, and of the 16 stocks, I chose a few that are in each different type of category. I have some in consumer cyclical, some that are in consumer defensive, some in telecom. I have one in REIT, some healthcare stocks, technology, and financial services. So, as you can see, I'm already well diversified across all the different types of industries. What I did next was I took my $1,000 and I just wanted to evenly spread it across all the stocks that I had. So, what I did was I took this $1,000 and divided it by 16. That gave me $62.50, which means I can put this amount into each stock. If you have a look at column D, it shows the amount of shares that I get for each stock for their current price. If you notice, these are all really large companies. These companies aren't going anywhere. What I wanted to do as a little bit of a bonus is highlight some of the stocks that I picked for my dividend investing portfolio and explain why I picked them. The first is Home Depot. If we take a look at Home Depot using Yahoo Finance, currently it trades at $300.04 at the time of this recording. The 52-week high is $347 and the low is $264. They pay a dividend of $8.30 at a 2.8% yield. If we take a look into their statistics, we see that they have a profit margin of 10.87% and their dividend payout ratio is 45.54%, which means that they're paying roughly half of their profit as a dividend. Home Depot is not a dividend aristocrat. However, Home Depot remains financially stable, meaning the company will at least continue to grow their dividend in the continuing years. Home Depot pays a much higher yield for their dividend in comparison to some of their competitors. Another stock I want to talk about is Coca-Cola. Coca-Cola currently trades for about $64 at the time of this recording. The 52-week high is 67.20 and the low is 54.02. It's not too much of a volatile stock. They pay a dividend of $1.84 at a 2.87% yield, and their payout ratio is 80.37. They have a nice healthy profit margin of 22.19. Coke has one of the longest running dividends ever. It's been paying and increasing its dividend for the past 60 years, which actually gives it a better status than Aristocrat, and we call it a dividend king. I think it's another great company to hold in a dividend investment portfolio because 1, it's simply not going anywhere, and 2, the dividend has been continuing for the past 60 years. It's pretty much guaranteed at this point. And 3, it's kind of recession proof. I think that people are going to be drinking Coke no matter if the economy is good or bad. I will say, with Coke, you're not going to receive a ton of growth out of it, but you will receive a consistent dividend which is quite nice. Lastly, let's talk about Visa. Visa currently trades at $234.05 at the time of this recording, and their 52-week high is $235.57 and the low is $174.60. The dividend right now is paying $1.80 and their dividend yield is 0.77, which is pretty low. Their payout ratio is a very moderate 22%, but they do have a really high profit margin, which is 50.28%. I would buy this stock to get a mix of slight dividend, but mostly for the appreciation of the underlying company. In the world we live in today, debit card usage is only going to increase, along with the payment volume. Again, Visa isn't going anywhere. If anything, I think people are going to start using debit cards way more than cash going into the future. So, there you have it. That was the dividend portfolio that you could easily start with $1,000. I'm going to be making this portfolio available to download so that you can analyze it. If you have any questions on money or personal finance, I have no problems answering it. I hope you found this video valuable. If you did like it, please make sure to like the video and also subscribe to my channel for more videos on personal finance, investing and entrepreneurship. Lastly, if you would like a free stock from Stake or eToro, check out the links in my description.